So good morning, everyone. Suprabhat, and thank you so much for joining on this webinar. Myself, Amit Manjrekar, I heartily welcome you all for this first kind of initiative from Aditya Birla Sun Life Asset Management Limited. So Niveshako is Samvaad, right? So Niveshak, of course, is an investor, and Samvaad it's like continuously dialogue. So this program is meant beyond the professionalism, any so-called uh, presentations and trends. This particular platform is going to discuss what's good for your portfolio, which are the interesting trends which are related to the markets, upcoming themes. So this platform is not going to only discuss about the wealth creation, but how to capital protection and how to down protect your wealth also. So for this first kind of initiative, you can definitely say this is kind of man ki baat between we, Aditya Birla Sun Life Asset Management, and you. And for this, we have two special guests today. So let me have an honor to introduce our first guest, our CIO, Mr. Mahesh Patil. So Mr. Mahesh is the Chief Investment Officer of Aditya Birla Sun Life AMC Limited. As a CIO, Mahesh oversees over 2.7 lakh crore of asset under management, which is close to 30 years of the rich experience in funds and investment management. Mahesh leads the entire investment team comprising fund manager and analyst. Mahesh has been Aditya Birla Sun Life AMC since 2005, where he started as a fund manager. In 2008, Mahesh became the head of equity and subsequently CIO equity in 2011. He was given the charge of spearheading of overall investment function as a CIO in 2021. He personally manages funds such as ABSL Frontline Equity, ABSL Focused Equity, and ABSL Multicap Fund. As an engineer from VJTI Mumbai, Mahesh is an MBA in finance from Jamnalal Bajaj Institute. He is also a charter holder from the Institute of CFA, Hyderabad. So thank you, Mahesh, for joining us on this webinar.
Thank you, and good morning, everyone.
Yes. And let me quickly hit the first question, which every investor wants to know, that fear of missing out or fear of losing out 30, 40, 50, 60,000. How do you see equity as an asset class?
So it's been a pretty good journey, right, in equities in the last 1.5 years. It's been a stupendous rise and surprised everybody, including me, the way the markets have rallied. If you look at year till date, India would be the best performing market as of now and across globally. In fact, India has outperformed some of the emerging markets as well as the developed markets. But the key question is what from here on, okay, where do we see things moving up from here? As you know, this year we've seen a big rally, not only in the market, but it's been a widespread rally, right? For the first time, we've seen the breadth of the market has been good. The mid cap and small cap indices have outperformed significantly year till date. And it is to a large extent led by a cyclical sector, right? The cyclical sectors like metals, realty, consumer durables, capital goods, infrastructure, they have outperformed the other defensives. So it's a rally which suggests that we are in a cycle, okay, which is an expansionary mode, and the economic recovery will pan out in the coming years, and that's what the market is cheering. Globally, also, we have seen a strong recovery coming out. But now, since the markets have rallied so much, the key mood question here is that the valuations are also at the high level, right? So I don't know whether, do we have that presentation? So as I was saying, that the challenge is that the valuations are at the high levels. I mean, if you look at compared to historical levels, if you just look at the PE multiple or the price to book value multiples, I mean, one would assume that the market is kind of a topish and one should be exiting the market. But that's only the half part of the story, right? Valuations are higher for multiple reasons. And one can argue that globally, the valuations have structurally moved up because there are a lot of sectors, okay, which are now displacing the indices. I mean, traditionally, the indices had a lot of cyclical sectors, which were there, if you look at 10 years back, that was what driving. Now the composition of the non-cyclicals in the index has gone up by almost like 15 to 20%. There are a lot of these technology names which have come up not only in India, but also in the US, which are now contributing a large part of the market cap. And as you know, in these sectors, the multiples are always on the higher side than the traditional sectors because of the high growth and the high cash flows which they generate. That's one part of the story which is there. Second is that we all know the easy monetary conditions, the easy financial conditions, low interest rates. So that's likely to the valuations are much on the higher side. But the other question is that what do we see from here? Right? I mean, again, if you look at another valuation parameter, which is the earnings yield to bond yields, okay, which is also shows how the relative market is looking compared to the fixed income side. So there also we are below the long-term average, right? The chart suggests here that if you're below the line, that means the market is less attractive. But again, it's not nowhere to the levels, okay, where it was earlier. So clearly on this front, probably it's not looking as expensive. But the point I would like to highlight over here is that whether this is the top of the market, right? That's a question which is there probably in everybody's mind and one should exit. So there I would say that it's a bit different this time. And we try to put some analogy here, looking at the earlier market tops which were there in 2000. Okay, this was the dot-com, okay, which we saw, right? Just before the dot-com crisis, okay, driven by the IT sector. And then 2007, okay, when the market peaked out. And now to 2021, if you look at, in these periods, okay, 2000, 2007, the average GDP growth prior to the market peaking out was very strong. So we had gone into a fairly decent economic growth, especially if you look at in India, right? So in 2007, we had stupendous growth, right? We had 3-4 years of very strong growth, 8 to 9% kind of a growth. Whereas this time around, we've seen that we are getting into a period where the growth has been muted, obviously partly because of the pandemic. But even if you take out 2021, the growth of the economy pre the pandemic was also below 5%. You were tracking that. So we are coming in from a lower base, right? And we are at the beginning of an economic recovery, which is led by the whole. We'll talk about that, but it is led by large liquidity. But also there are strong pillars for economic growth going forward. If you look at inflation, especially the CPI is more important, I would say, because that talks about economic activity. The CPI is also her WPI, the average and WPI and CPI, if you look at it, is still much benign. While there is some fear, and we've seen inflation go up recently because of the supply side constraints which were there. But by and large, inflation, if you look at average inflation, is still low, especially WPI. So inflation is well under control. Interest rates are also not at its peak, right? So we in 2000 level, the GSEC yields were around in double digits. In 2007, they were around 8.5%. Currently, we are tracking at around 6.3%. So again, interest rates are relatively low. So while the P multiples and the price to book value multiples are kind of similar, but what it suggests us that not everything is suggesting that the market is at the top. There are other factors like the inflation, interest rates, the growth rate past is we are coming up economic cycle, so we should see very strong growth reasonably strong growth in the coming years, and that is what makes us still bullish on the market here on. Though we would argue to say that the market from a short to medium term perspective looks to be fairly priced, and there are some risks over there. But for a long-term investor, there are still reasonable returns to the market is nowhere near its top. There could be intermittent corrections, but it will continue to scale higher. And the key positives, okay, for the Indian economy, okay, which will support the growth going forward, is that one is there are a couple of legs to the economic growth going forward. If you look at the real estate sector, that is also, we think, beginning of a new cycle, and we'll talk about that later in terms of our emerging the long-term themes which we're looking at. But compared to the last 5-6 years, this sector is, again, a large part of the economy which is starting to fire and likely to do well going forward. Investments to GDP had also crashed in the last 5 years, have been going down. There is enough reason for us to believe that private sector investment will pick up. Again, we'll talk about that in the trend-setting themes which we are looking at. So these will be the two pillars, okay, which will drive our economic growth on the domestic side, but also on the external front. On the export side, also we are seeing very good traction. The IT services sector, as you know, is doing well, driven by the whole focus on digitization global companies trying to go digital, going to the cloud, and that's a good tailwind which is there for the IT sector. Again, which the growth rate, which was around mid-single digit, is now looking at double-digit growth going forward. Also, exports are driven by the China Plus One strategy, which is again a big change. It is a big long-term structural change which we see. We'll talk about that again later, which is driving sectors like chemicals, textiles, and the auto ancillary sector. So that will also likely to be another leg of growth. And on this backdrop, I think if you look at the overall liquidity conditions in India, right, has never been better. Again, both more so on the FDI flows. India has received record FDI flows last year. Again, this year, okay, in FY22, okay, we're expecting around $75 billion, $70 to $35 billion of FDI flows, which will be probably equal to or higher than what China has got. That's a huge amount of money which is coming in, which is going to go into the hands of some of these startups, okay, which will be spent, right, either on salaries or consumption, and that will also support growth. And this flow of money which is coming in is not going to abate, right? There are a lot of India has now emerged as a destination for foreign FDI flow, especially driven by the new age companies and the new tech startups which are coming up. So that's opening up new doors for the space, and that will continue. And as a result of that, we are in a very comfortable situation. The forex front, the forex reserves are fairly strong. So I think we are. If you look at what gives me confidence here on the market at this point in time, from a say medium to long-term perspective, is that we are at the cusp of beginning of a cycle, economic cycle, okay, which would ensure growth will be close to around 6.5-7%, which by the way will be the best growth you will see amongst many large economy, better than even China now. So that's one, and we would see overall the macro situation for India is now much better than what it was. So that's the long-term view. Obviously, there are near-term challenges, okay, which will be there. Besides the high valuation of the market, there are some concerns, okay, which we need to be aware about, say, in the next 3 months or so. The rise in the oil prices and the commodity prices, okay, can lead to higher inflation and can not only impact the margins of the companies, but can also lead to globally. There is some debate about where interest rates needs to go up, and the Fed needs to increase interest rates in light of this inflation. But I think we'll have to wait and watch and see, because this inflation is more driven by supply side issues, which can be transient and can be addressed. But clearly that is one risk. And we've seen recently the bond yields again have started to move up. US 10-year bond yield has risen to around 1.7%, which had reached almost a low of 1.2, 1.3%. There was a rally of around 50 basis points in the last couple of months. And that could be slightly worrying sign, okay. But again, that could lead to short-term correction. But we're not really worried about that, because I think if the economic growth increasing interest bond yield is supported by economic growth, then it should not be a worry until probably the bond yield goes to around 2.3% or so, where the yield gap ratio in the US reaches the long-term average. So that's another point to really note. And then they talk about tapering sometime later on in this calendar year. Okay, in the early part of next calendar year, you would see tapering start to happen, and that is something which can lead to volatility. So I think there is important to be cautious over here at this point in time. We would be wanting to take out some beta at this point in time from our portfolios. So some amount of profit taking in high risk stocks or high risk funds would definitely be advisable over here. Could be some volatility down the line. We've seen now there is some headwind coming in, okay, the broader breadth of the market. So that is something which we need to be worried, I think. But this is a market, I think, to be bought into the dips. I don't see, unless there is some major global event, a large correction, probably a 10% correction is what one can expect over here. and one should be positioned for that. Uh, Overall returns in the market, I think as equity as an asset class, which you asked, should still be fairly okay. Not a very high return, considering the fact that we are coming in from a place where the valuations are already higher, but still reasonable returns to take care of the inflation as well as the underlying interest rate scenario in the economy, which we think will still be low. At least for the next 1.5 years in India, interest rates will remain low. So equities can still give you slightly better returns adjusted for the risk, is what we're talking about. And at this point in time, I would say that it would be better to say remain in the large cap names because some volatility you could see more correction in the mid cap and small cap space. There has been a big rally what we see in the last 1 month. I mean, some of these small cap, mid cap stocks have gone up beyond proportions, probably driven by the retail money. I think there is need to have some caution, exercise some caution, but no need to be too perturbed over here. Another point which I wanted to show you was about the earnings growth. So we are probably after a long period of time where the earnings growth trajectory was around, say, in mid-single digits from 2015 or 2020. We are now getting into a slightly higher earnings growth, double-digit growth. I mean, this year, FY22, we're seeing a very strong growth of around 35% or so for the Nifty earnings. Again, this is primarily driven by the metal sector and to some extent the banking sector. But even beyond that, in FY23, you could see earnings growth somewhere in the mid-teens, which is still a very, very healthy growth. And there are multiple levers to that, multiple sector firing. A lot of companies have deleveraged, balance sheets are good. So we should see this earnings cycle continue for at least a few years. So I think that's where we stand. Still positive from a longer term perspective to muted returns. Near term, a bit cautious over here and one should take some beta over here is what my advice would be.
Thanks, Mahesh, for reiterating, investors' confidence once again in equity as an asset class. So the core subject of today's webinar that recently we have come out with a trend spotting report, which has been, really appreciated by the media also. So can you brief what is it exactly and how it's going to help the investor and what investors should look out?
Yeah, so I mean, as a fund house, we always keep on, while we focus on bottom-up stock selection and looking at individual stocks, that's our day-to-day job. But we also have developed now a good macroeconomic cell internally. And that helps to really get a good blend of top-down, long-term themes, trends, which we'll see, which could influence the underlying stocks and the market. And in that process, we have identified these key themes. These are the 5 themes which we think will play out over the next 2 years, 3 years. Some of them are more long-term in nature. And we've seen that if you're able to get the top-down call right, if you're able to get the big drivers, of any particular macro trends, then I think your bulk of the job is done. Right? Then it's just looking at the companies within that sector. So while we did that exercise at the beginning of the year, these are some of the things which came out. So the first one is the digital transformation, which we are all witnessing now, especially after COVID. It's been a big change in terms of how companies are trying to do in terms of trying to modernization of the core infrastructure and adoption of the public and the hybrid cloud. So that is one big theme. Second one is the rise of manufacturing, which I talked about earlier, right? We are seeing for the first time now, while this manufacturing thing was talked about 5-6 years back by the Modi government, but now it is getting shape and direction and momentum is what we think. That's another theme. The other one is sustainability. Again, this is a relatively new one, which is now increasingly getting a lot of traction globally towards responsible investing, towards a sustainable business. And that is likely to drive not only new companies, which will be, but also existing companies which are able to grow in a more sustainable manner. We'll talk about that. The other theme which we see is the cyclical recovery in the real estate sector, which again I talked about earlier. There are structural tailwinds. We'll see about that. And then finally is to play the economic recovery and the cyclical recovery in the economy. We think the banking and the financial services sector and the new emerging fintechs, could be the other themes. We will take these themes one by one. The first is the digital transformation theme. So as you know, India has seen a big revolution, on the mobile penetration, mobile digital data penetration, thanks to the cost of data in India because of the large competition, thanks to Reliance Jio, is the cheapest in the world. I mean, if you look at the data, it's even compared to some of the emerging markets, it's very well. It's just at around 30 cents per GB, right? But more importantly, I think the penetration of internet users, because of the low cost of data as well as the cheap handsets coming in, has also gone up. Currently, we are at around 600 million internet users, which is likely to go to around 900 million internet users by 2025. And Indians have seen leapfrog really in terms of data consumption, which is one of the largest in the world. So clearly, people in our country have adopted digital in a big way. Mobiles have enabled that, and we have leapfrog, many times. But even the companies, the corporates are also in phase. They have realized that unless you invest into digital, you will be lagging behind. And during the pandemic, we saw many companies realizing that they hadn't really spent on digital, and there is a emerging rush in companies to spend towards that, be it towards spends towards moving toward the cloud-led services, or also towards automation in an effort to reduce cost. And I think in this new world, data is again big, right? How you analyze data and do data analytics to reach out to a customer, I think that's again coming up as a big source of competitive advantage. So as a result of this, we've seen that there is not only increasing spends towards digital, but also how companies adopt digital is going to change the landscape in terms of how they're going to be competitive. And that's, I think, what we will look at. So we already know the whole story about IT sector, which has been the best performing sector in the last 2-3 years, and still holds promise over here and the best visibility of growth going forward. But the benefit of digital transformation is not only limited to the IT services sectors, and especially companies and IT sector, which are catering to the digitals in a big way, like say Happiest Mind or Infosys or TCS, but it is much more pervasive, I would say. So the adoption of online retail, in India has picked up significantly, and there are new companies. Initially, this model was the domain of Amazon, but there are now newer companies which are coming up in this space. Companies like, soon you will see company Nykaa, which is there in the beauty space, coming to the market. There are companies which are like Affle, for example, which is helping companies to really advertise effectively on the digital side, on the online platform, which is also benefiting out of this. Reliance Jio retail platform. So all these new companies, companies which are likely to come in, and you will see some winners over here on the space. Also, the adoption of automation by corporates, especially in manufacturing, is also picking up, and companies are doing that not only to give a competitor, but also to reduce cost. And that is gaining dominance over here. So companies like Honeywell, ABB, Siemens, which are globally at the forefront of automation, are some of the names which one could look at. Then there are the platform companies, which are emerging, which are not only in a particular domain, but they offer the whole range of platform in particular verticals, which is again gaining attraction. We've seen the success of Zomato, which is on the food delivery side, which has been a big beneficiary recently and had a successful IPO. But even the traditional companies like Jubilant, right, has adopted digital in a big way. And now it's not just giving pizzas, but it is looking at it as a food delivery platform, a food, not delivery, but food manufacturing platform company, and they are looking at other products coming into the space. So that's even company like Bajaj Finance, right, which is in the traditional financial services space, is looking to be a platform company and not just selling lending, but also offering other products and services to its customer base, be it insurance, be it broking, be it investment products, and looking at a larger, bigger picture. And then there are the fintech players, right, the disruptors, okay, who are coming into the space, right, which purely on the digital side, without a physical infrastructure, and trying to create a business model. So these are other companies, and they are across the space in the financial services sector, mainly the financial services sector, whether it's the broking side, whether it's in the payments side, or whether it's in the insurance side. So there's a whole gamut of things, okay, which is companies which are coming up, which will, not everything will be successful over here, right? Not everyone will emerge. There will be a lot of companies which will probably go by the wayside. Some of these companies are still not making money, but there is always an option value, and there could be winners. And we've seen big value creation happen in this space. In US, okay, we have success stories. In China also, we've seen that until the whole government clampdown came in. So this is a space which excites us. One has to be careful over here in some of these new generation companies, and do a proper due diligence. And we are trying to build capabilities over here. But again, great opportunity in this space. The other theme is about the rise of domestic manufacturing. For the first time, actually, we are getting positive on this space. Again, if you look at the factors, we've been talking to get our manufacturing as a percent of GDP, which has been at around 14 to 15%, to take it up to 20%, but haven't been successful for many years. And the reasons for that were the poor infrastructure, what we had, the high logistics costs as a result of that, which took away almost 8 to 10% of the cost advantage which we would have. In some cases, it was the inverted duty structure and the restrictive labor laws. But I think, credit to this government, I think in the last 4-5 years, they have worked on this. And now we see some of these bottlenecks which were there are being addressed. So on the tax side, we've seen the cut in the corporate tax rate, okay, significantly for greenfield projects to 17% or so. The increase in import duty on finished good and its components, okay, so that has taken into consideration the inverted duty structure wherever it was. So that gives protection to some of these domestic companies who want to really invest. And then obviously the PLI scheme, right, which has been promoted by the government to give production-linked incentives in various sectors. We'll talk about that. And on the back of that, what has aided recently is the diversification of the global supply chain, right, which has been accelerated after the COVID crisis. China, which was a big supplier to the global supply chain, companies are now looking at the China Plus One policy as an alternative to China. And that has opened up opportunity for many companies. And the sectors to benefit out of these would be in the chemical sector. We've seen the success of many companies here in the last. It was initially driven by the whole restrictive policy, the stricter pollution control norms, okay, which were there. Now China had to implement. But now it is looking much more structural because of some of these things. Pharmaceutical API companies, industrials, because of the capital goods sector, okay, because of investments which will happen on the private sector capex that will drive the growth of the industrials, and auto ancillary. So these are some of the sectors which will benefit out of this. And so we talked about this. This chemicals, again, we've been positive on that space for quite some time now, and especially the specialty chemicals, but also in the commodity chemicals, we've seen that because of shift from China, and India has got a very good ecosystem for chemicals, right? So it's pretty well integrated to that extent. And with the PLI schemes coming in, the government incentivizes companies to go backward integration. So dependence on China for some of the key chemicals, okay, will come down significantly. Again, the sector is slightly expensive, has got re-rated, but I think it's still a good structural long-term sector. So one will definitely looking at the sector at this point in time. Defense, again, has emerged as a large sector where the government has taken initiatives, right, with increased FDI and defense, which nobody would have thought, okay, the government will take FDI beyond 50%. And the government has identified various products in defense, okay, where there'll be embargo on imports, and they will have to manufacture locally. So that will benefit companies in this space with a lot of opportunities, though the overall defense spend might not increase significantly, but the import substitution, okay, which will be there, will mean opportunities for Indian companies to benefit out of that. Pharmaceuticals, okay, India has been always a pharmaceutical formulation story in the US market, which has been a great story in the last 15 years or so. But I think the whole bulk drug industry, the API segment, okay, which is there, the active pharmaceutical ingredients, that is something which is likely to get a boost because of the China Plus One policy. And with the collective support of the PLI scheme, I think this could be a sector which again will throw up opportunities. The consumer electronics and durable sector, again, sector where the government is again focusing on a lot of imports were happening in this space, right, from China, but with the focus on domestic manufacturing, the support coming in from the PLI scheme as well as import duties on some of the components, again offers an interesting opportunity. And then finally, the capital goods sector, right, which is the secondary derivative benefit of the increase in manufacturing, because that will lead to a larger order book for some of these industrials and capital goods sectors. So these are sectors which one could look at really to play the whole manufacturing theme. The third one is the revival of the whole real estate sector, which is again a large part of the economy, directly as well as indirectly, as we know. If you look at this sector, has been since the last 6-7 years, since 2014 or 15, I would say, has been fairly stagnant. We see property prices have remained stagnant for the last 6-7 years. And as a result of that, over a period of time, as the income levels have gone up and as the interest rates have gone down, the whole affordability gap which was there has come down, right, significantly. So if you look at the spread, okay, which is the interest rates and the rental yield, that has been the lowest now in the last 15 years. So after 50, 60, I mean, I remember interest rates where they are currently, they were a fixed rate loan, okay, at less than 7%. We are at those levels. That's clearly likely to aid the sector. And overall, I think the sector is now seen some consolidation happen. I mean, after RERA, there was, before RERA, there was a big lack of crisis of confidence in the sector because a lot of developers had stressed sheets, a lot of developers, there were a lot of incomplete projects which were there. So now I think the overall inventory in the system is starting to now come down. In the last few months, last 6 months, we've seen a good absorption of new projects which has come in. Again, to some extent, it has been aided by the support given in stamp duty reduction. But I think the overall cycle is clearly starting to now move up. And that is something which we think normally we see this cycle when it starts to move up. It's not like a 1 or 2 year cycle, it's slightly a longer cycle. And this the whole landscape in the real estate development has changed. I mean, the small developers which were there, I think, I mean, recently I was talking to a real estate consultant and seeing the total number of real estate developers, which used to be in the thousands, has come down. It's come down almost like 60%. That means that you will get more reputable names coming into the space. Also, more organized funding is coming in the sector, which means that the cost of funding, okay, which used to be very high for real estate developers, used to be anywhere between 15 to 25%, also in some cases, is likely to come down. A lot of the large developers are now borrowing at around in single digits, right? So that reduces, because that's again a long lead time, right? If you're projects get delayed, the construction cost can lead to increase in the overall project cost. So, and I think with the IT sector now again bouncing back and the huge money which is coming in into the startups, you would see demand for housing will again start to go up. And India always had a latent demand for housing, right? It was a question about the price points, which was there, and also getting the confidence back. And also developers are now coming up with projects which are more tuned to the target market, and the ticket sizes are probably much lower. So that's clearly the sector. If you look at the cycles where we are, we've seen all these 6 cycles play out. The chart shows that we had the early recovery which we saw, right, from 2007 to 2010, and the market peaked out in 2012-13, which was there. And that peak in demand for new housing units, which was close to around 4 million units annually, okay, that came down to almost less than 3 million units in 18, 19, 20. And now we are seeing this cycle starting to play out. So how do you play this cycle, right? One is obviously the real estate stocks, but probably that's not the only way you can do it. But one can do that directly through cement. While cement demand comes from infrastructure, but a lot of demand comes from the housing side. And again, the cement sector also we've seen decent consolidation happen. Up till now, it was more of a pricing game for cement, but I think going forward, I think we could see the demand revival also coming in. You can look at home improvement companies, building material companies, which are again likely to see as more construction housing dwelling units get developed. You could see a demand for that coming in building materials. Contractors, EPC contractors, okay, which are focused mainly on the housing side, and I mean the housing finance companies, right? Obviously, because anybody, especially we've seen increasingly as people are buying housing more for own usage, there's a tendency to really go for a housing loan because you normally always don't have the capital, okay, to make the upfront payment, unlike investors who do that. So housing companies would also benefit. So there's a gamut of sectors which you could play riding on this whole real estate recovery. The fourth theme is the sustainability theme. So again, globally, if you look at, right, the top 5 global risks in terms of likelihood, which a global survey was done. If you look at in 2020, most of these, all of these were actually somewhere revolving around risk from the environment and environment and social side, right? So whether it's extreme weather, climate loss, human-made environmental disasters. So clearly, I think realizing this, I think the global leaders and everybody is now really looking at how do we really run businesses, okay, in a much more sustainable manner, and that has led to a big shift and focus on ESG investing, right? So what are the pillars of ESG? Just to understand that, obviously E stands for environment, right? So the factors which impact our planet are the factors over here, whether it is the carbon emissions, the climate change, what we're talking about, the temperature increase, global warming, energy efficiency, water and waste management. And this is, I think, one of the most critical factors now, which is coming up center stage. Companies have, not only companies, but countries have now set up targets, right, for zero emission levels. Each country is now trying to do that. But companies are also now coming up, setting up targets, okay, when they will be carbon neutral and adopting that. Social factors, okay, also which are impacting the lives of people, like increasingly with now people getting digital data protection and privacy is emerging as a big concern over there. Gender diversity, community relations, and finally the governance part of it. Governance was always there. I think it had probably taken precedence earlier as a part of ESG sometime a few years back, and we've seen in India also companies with poor corporate governance getting punished and companies with good corporate governance getting rewarded. So I think these things will only gain prominence going forward. And directionally, we think the world is moving towards more responsible investing. And the sooner we realize that, right, and adopt that as a part of our investment process, the better it will be. So all these things, so companies which we are really moving in that direction are seeing not only support from investors coming in, which is lowering their cost of capital, but also they are getting regulators and this thing increasingly are looking at this in a larger way. So companies which are doing are getting more favor from the regulation side. And so that is something which we think will likely to change the whole landscape. As I said, reduce cost of capital, improve efficiency, which have, so actually where people are investing into more responsible investing, actually in some cases it's also leading to improved performance. And while it's still early days, but the money which is now moving into the whole ESG theme is only increasing, right? But I mean, the initial study shows that companies which are having high ESG scores are seeing data suggests that the Nifty ESG index, okay, which has generated a slightly better alpha than the Nifty index. And so while the companies are adopting ESG as a part of their whole integration, and that's one to look at. But I think the more important is to look at how it benefits other companies, okay, which are now likely to see because of the thrust on corporate spends towards ESG. So a few sectors which I'd like to highlight over here are we all know the thrust on in India specifically, there is a green thrust on green set targets to increase the ethanol percentage, okay, in blending, and that is another area which will benefit companies, okay, which whether it's sugar companies which are now setting up ethanol plants, or companies like Raj which are manufacturing some of these blending units. Obviously, green mobility is something which has been talked about, and India is likely to see more thrust towards electrification, especially early adoption would be in the two-wheeler space, and companies which are now gearing towards that and trying to ensure that they are ready for the e-mobility space, again, will probably get rewarded. And also companies which are adapting now, right, to the new landscape, right? Traditional companies, okay, which were providing supply drivetrain and the engine side, we have to look at the new demand for components, okay, which will be driven more by the electric vehicles. Besides that, companies which are creating clean technology, right, ensuring that there is zero carbon footprint, okay, which is there, and investing in that technology again could be the company. Green energy, right? Again, so globally, fossil fuel and zinc consumption is coming down, and the focus on green energy, be it early it was wind, then solar, now it is and hydro. We're talking about hydrogen also as a alternative. It's still early days. Again, companies which can adapt to that and build business model on that, I think could likely to see the growth, because I don't think you'll see more investments coming into the fossil fuel side. So these are some of the sectors, okay, which some of them are new sectors, emerging sectors. But as these things catches momentum, okay, you'll see opportunities coming back in this space. And the final one is a more traditional theme. Okay, nothing new about it. It's more playing the recovery, the cyclical recovery in the economy. And what better than to play through the banking and financial services sector, right, which has always been there. But again, more, I think, so I think you would like to play through the private and the corporate banks, which we have seen traditionally. Private banks and corporate banks, private banks specifically, have been gaining market share from the PSU banks, right? From like PSU bank market share used to be like 80% in 1996, which has now come down significantly, more so in the market cap size, right? And it's been taken by the private banks. But within private banks, also, I mean, we always like retail banks earlier, right? Because that was where the growth was. Corporate banks went through a large NPA cycle in the last 2-3 years. But I think now we agnostic to that. I think you will see growth in the corporate banks also because the NPA cycle, large NPAs, and also what we saw is behind us. And really to play the whole credit cycle, the banking sector would be the preferred sector over here. If you look at the banking index or the bank Nifty, has still underperformed the broader market, right? Recently, valuations are still reasonable. Okay, they're not cheap, but if you look at the long-term average, they are still near the long-term averages. Also, the big fear about COVID, which was the second wave of COVID and potential third wave, had kept the banking sector slightly a bit laggard, I would say. But now I think it looks like the third wave will not likely see a major kind of issue over there. And I think the banks have adequately made provisions, big provisions last year. So we don't see any increase in the credit cost coming through. And whatever growth comes in will flow down and will lead to margin expansion. So the growth, the earnings growth in the banking sector, and especially the large private banks, even the corporate banks, even the PSU banks will do well in this environment. And so there could be some some tactical plays or trading bets in the PSU banking space, because when the corporate cycle does well, PSUs also benefit. But for structure, it is always going to be the private banks, okay, which will gain market share. And more so, I think banks which are able to adopt technology, right, in a big way will be the key differentiator. We've seen what happened to, say, HDFC Bank some time back, because they had some problems on the digital side, and the market also punished them. From the regulator punished them, but also market punished that. Other ones like ICICI, which were more, which is more ahead in terms of technology adoption, we've seen has got re-rated, and that, I think, would trend will continue. And besides that, I think the banking sector, the financial sector, I think while they continue to gain market share, the non-lending NL financial institutions are also seeing a structural growth story in India, right? Because of the whole financialization of savings and the low penetration levels, okay, capita incomes going up, be it through the life insurance space, the general insurance space, asset management companies, broking companies, capital market companies. So all these sectors are also something which looks promising. And then finally is the emerging fintech, which is a new frontier, right? Which is a kind of a new landscape for us to really look at. But again, these are the disruptors in the financial services sector, be it in the traditional categories like cards and payments, or on the lending side, be it personal finance. The newer banks, okay, which are coming up, are kind of they are potential threats also, okay, but what potentially opportunities also which can come up in this space. And then India is a growing market, right? And with the credit growth picking up, with the investment cycle picking up, I think there will be a growth which has still been lagging. I mean, the credit growth up till now has been in single digit, but we see that moving up to around mid-teens going forward. So this is again a broader theme, which is more traditional theme, which we understand much better and which we have played out earlier also, but we think can do well going forward. So that's the broad trends and the themes now. And how to play that through the portfolio. Then this thing I mean, there are various funds, okay, which you can look at it, but obviously some of these things would be adopted in our traditional funds because this will be some of the guiding principles which will drive our portfolio construction going forward.
Sure, Mahesh. I think thanks for sharing. And quickly, how investors can benefit for all these themes from our ongoing fund. So what's our recommendation on that?
So, I mean, these themes would be there across, I think, all our funds in various ways. But if you ask me, which are the funds which you should be looking at and how do I see the current market scenario suited for some of these funds? So clearly, I think a bias would be slightly more towards large cap fund at this point in time. And with a longer term story, I think flexi cap or a multi cap where your larger allocation should be is what I would suggest, right? In the large cap space, the frontline equity fund, which is the more diversified fund, would be the best fund over here, because then you can play the various themes in different ways, because some of these things would be niche themes. You can't do a large allocation over there. but front-end equity fund historically has had a good blend. I mean, it's mainly a large cap portfolio, but has had some mid caps ranging from around 10 to 15% of the portfolio, which can benefit out of that. And within the multi-cap diversified portfolios, the flexi cap fund, okay, which is a fund which has got a long-term track record, a consistent fund is something which I would recommend. Slightly more conservative, it's a blend of it's more top-down focused fund, which believes in taking large down calls, contra calls, and definitely you could see a fund that is oriented portfolio, then the BSL equity advantage fund is what I would recommend. That will be a large part of your portfolio. Something I think mid and small caps, but still continue to get some allocation because over a longer term, I think they still continue to generate good returns as the domestic economic recovers. So there, I think a small cap fund, which is now our analyst managed fund, which we are focusing on, and which each analyst looking at this fund across the various sectors and the themes, I think we should get good ideas coming in, representation across the broad themes coming in. So that's on the core part of your portfolio. Your financial services fund, if you want to play the whole banking theme, the financial services theme, which we are bullish on from here, though it might not be a structural theme, but cyclically, I think that's the sector which looks good at least for the next few years. ESG, we talked about the whole sustainable investing, the way of life. In India also, it's catching momentum, and we've seen a lot of fund and money coming into that space. So a Birla Sun Life ESG fund, which we launched, I think around a year back now, has done very well in its own segment. But again, would be a great fund to really play the whole sustainable theme going forward. So these are the funds I think which I would recommend. But obviously, the market here where it is, right, with some concern about short-term correction, some hesitancy in terms of whether to invest in the market at this point in time or not. I think for those investors, I would suggest the Birla Sun Life Balance Advantage Fund is the right fund to look at. Again, the fund has recovered very well amongst the top performing funds in that category. But this is a fund which you can invest at any point in time, at any cycle of the market, which one would look to invest.
Sure. Thanks, Mahesh. Quicker to the next one. Recently, we are planning to come up with a business cycle theme. So can you throw some light on that? How this theme is and how it's going to help the portfolio?
So again, this is, again, as we come out with various products, I think new products where we think, okay, it makes sense for the investors. This was one of the themes, okay, which products which we thought about. Again, this is a product which has got, I mean, no need to time that product. Okay, it's an all-weather kind of a product where the emphasis here is clearly on top-down, right? On the macro calls, the top-down calls which we are taking. And every portfolio has a blend of top-down and bottom-up, right? But in this fund, we first start off with the top-down, the macro, where the economy is positioned on what business cycle we are in at this point in time. Okay, that is something which we look at. And then accordingly, okay, how do we invest? Right? Which are the sectors, okay, which you need to invest upon? That's the underlying philosophy of this fund. Traditionally, we've seen people have a set template for investing. Like if you are in a down cycle, right, then you would be more investing into say defensives or whatever, or these sectors will do well in a rising economy. Okay, these sectors will do well. But we look at it a bit differently over here. We are looking at all the sectors divided into cyclicals and non-cyclical. And we would not only look at the business cycle, but we believe that each sector also goes through its own cycle, right? And understand that and decide, okay, where do we need to allocate that? So just to get an example, for example, that the IT sector, right, would be the IT sector did well. Okay, normally when the global economy was not doing that great 2 years back, the IT sector still continued to do well because there were structural drivers to that, right? So that is something, okay, which we intend, I think, with our good blend macro research, which we have internally, and with this, some of these trend setting themes which we talked about, we hope to build up a portfolio which will able to generate alpha from these, not understand the market's business cycle and the industry cycle and the long-term trends, and taking a much more larger concentrated bets in these sectors to generate alpha. And we've seen that globally. If you're able to take the top-down calls right, I mean, that's the largest source of alpha which a fund can generate. And especially at these times when the alpha generation in the market is coming down, the market is pretty well more efficient, I would say, and information dissemination is very fast. So the only way to generate alpha is to really look beyond what is obvious, right? Taking a slightly forward-looking view in terms of what are the drivers, understanding where we are in the cycle, and that is probably can give us an edge, which we think will benefit this fund. I won't get into all the details of this thing because we have a separate presentation on that, and we've been talking to investors on this. But I think this is a fund which again can sit in the core part of the portfolio, right? At cap agnostic, right? In that sense, only thing is that it is has got another layer, okay, which we'll talk about, which is the top-down macro focus, okay, which helps us to allocate, okay, across various sectors, which also, by the way, gives some kind of a, I would say, position, right? Because we are trying to slightly look beyond. We are not really participating in just what's moving in the market. We're trying to understand the market. So obviously, market timing is a different issue altogether. But I think this is a fund which clearly can be a core part of one's diversified basket.
Yeah, thanks, Mahesh. And we have second guest. So I would like to invite Mr. Bhavdeep Bhatt, who is our head of retail sales. For paucity of time, Bhavdeep, quickly we will jump to the questions. So first question to you, that what is the trend you see in the SIPs? So at this market, what investors should do ideally, what investors are doing, or what advisors are suggesting? What is the SIP trend, and what is your view that one should continue with the SIP or they should discontinue?
Good morning, everyone, and thank you for joining us on this platform, which we intend to continue every month and spend time more on question and answers going forward, and take many questions. So thank you for writing in. On SIP, Amit, I think it's one product. There is never wrong time to start an SIP, and we have seen over a long period of time, the SIP is kind of doing its due. So 18 and 19 were the calendar years where generally you saw markets going up, and some of the funds which were diversified or small and mid cap heavy did not do so well in terms of investors' return. But just a little bit of patience, and even those products have kind of delivered substantial outperformance over benchmarks, and of course compared to other asset classes, over a 3, 4, to 5 year period. So I think there is no bad time to start an SIP, and currently we have kind of come out with this interesting idea called multi SIP, wherein we recommend to investors to start systematic investments across multiple products. And because there are multiple needs, and for each need there can be one SIP happening. And yeah, I mean, Mahesh has quite beautifully outlined some of the recommendations that we have in terms of how should one construct a portfolio with large cap, multi cap, thematic ideas, and small cap fund that we kind of talked about. So pick up 2 or 3 ideas from the basket of this recommended funds. And I think starting a multi-SIP is a wonderful idea. At an industry level also, it's very interesting to see that SIP block as an industry level has grown from 7,500 crore to 10,000 crores. And in some way, we are very happy with this because not only investors kind of make good money over a long period of time, but in some way, at a market level also, it's a great stabilizer for the market. I mean, about 1,20,000 crores of annual flows coming only through SIP is a great force in that sense. So very happy to see that this piece really growing for the industry, and this piece making good returns for our investors.
Thanks, Bhavdeep. We go to the next one, and that is also for you. There are so many NFOs in the market. So is it a wise decision to invest in the NFOs, and is it helpful to build up the portfolio?
Yeah, I think it's about NFO is just another fund that you have kind of to look at, with the portfolio, existing investors' portfolio in mind. So I think no fund is good or bad in its own. How does it fit into overall scheme of things for investors is very important. I'm very happy to share that because we have been very selective in the way we kind of launch our new fund offers. You would have seen that last five NFOs we have been able to kind of offer to our investors at very opportune time. So, for example, between 16 and 19, we kind of kept thinking of launching pharma fund, but we ended up launching in middle of 2019, almost at the bottom of the market. Similarly, PSU equity. So we kind of were thinking of launching this fund for 2 years plus, and we launched it when Deepam came out with this guidance that this investment will happen not through ETF but through strategic divestment and privatization route. So I think with that the savings glut, on the supply glut kind of came down, and we ended up launching the fund at a very opportune time for our investors. So we have been doing that, and fairly good track record. I'm saying we don't get all the themes right all the time, but most of the time we have been able to kind of offer NFOs not only good ideas but at the right time. And our track record suggests that we have been able to serve our investors with those funds performance, whether it's multi-cap that we launched recently or ESG fund that Mahesh talked about, special opportunities that we have launched about a year back, PSU equity and pharma, also banking that we launched in previous cycle. So I think, investor has to look at the fund in the context of the needs and the existing portfolio and see how does that fit into it. I mean, there is no one size fits all. But as Mahesh mentioned, business cycle fund is an evergreen or kind of all-weather kind of solution, because what happens is that we have been having a lot of sector and thematic funds which have worked very well for our investors over a long period of time. The key challenge at times for us is to kind of give the exit call. And in making good money in sector and thematic funds, it's very important that investors not only get reasonably good entry, but also reasonably well-timed exit. So we thought, why not launch a fund wherein fund manager on behalf of the investors will rotate sectors. So as you know, balanced advantage fund, for example, has become very popular for asset allocation. We believe that business cycle will become very popular for sector allocation. So where you are actually entrusting that job of sector rotation to fund managers. So without any communication transmission loss, fund managers can create an optimum portfolio with some of the sectors which are likely to do very well in subsequent cycles. So I think all these factors put together, we believe that business cycle makes a perfect sense as an all-weather fund for the allocation which investors have in their equity portfolio.
Actually, thanks Bhavdeep for this very detailed and crisp answer, because in a way it gives answer to the next question. Because question from the Mitenji asked that, how you guys will ensure as an AMC to give an exit call. So business cycle fund itself is a solution where, investors should not be bothered about the sectors, whether fund manager will take care of which are the performing sectors and where they definitely see a good alpha, where it can be helpful for the portfolio. My next question to Mahesh, and that is from Mr. Narendra. So he's asking, can we still have a hope from the large cap funds to generate alpha?
Yeah, so this has been a question which has been asked more, I think, a year back. Okay, when the funds were underperforming the benchmark, they're still underperforming from say some of the funds from the last 4-year perspective, 4 to 5 year. But I think we've seen various cycles coming in. There have been some narrow rallies in the market, but I think by and large, India, look at the market, the breadth is much wider, and the ability to pick stock picking, okay, if you're able to do that, okay, I think there can still be reasonable alpha which can be generated, though it will be much lower than what we have done in the last, say, decade or the last 2 decades or so, which is definitely going to come down. But looking at the fact that there are a lot of new companies which are coming up, India is still a growth market, so there are many high growth companies which are not part of the benchmark, right? Take Nifty, for example. Okay, just outside, which will be coming up. and you can participate in that growth before it becomes part of the Nifty, right? And before the index funds start to buy it and take it up. So I think I still believe that there is a reasonable alpha which can be generated, and we've demonstrated that, I think, in the last 1.5 years. Again, that trend has reversed and funds have started to beat the benchmark, which I think can continue, especially in this kind of environment. But I would say don't expect a very large alpha. I think an alpha of around, say, 150 to 200 basis point should be a reasonable alpha over a longer term, to expect from a good, well-managed large cap fund vis-a-vis the Nifty.
Thanks, Mahesh. Mr. Bhavin is asking that there have been slew of reforms in past of the few years. There is large privatization pipeline post Air India. In case of any adverse result in upcoming UP elections, do you expect any change in the domestic economic policy?
I mean, the question was answered addressed to me?
Yeah.
Bhavin. Okay,
To
I
you,
can
Mahesh.
repeat that question. Okay, can you repeat
Yes,
that?
of course. Yeah, of course. I mean, there are slew of reforms in the past few years and large privatization pipeline post Air India.
Yeah.
So in case of any adverse result in the upcoming UP elections, do you expect change in the domestic economic policy?
No, I don't think so. I think overall, I think the government has stuck to its gun. And especially if you look on the reform side, irrespective of whatever is there. And the classic example I would say is that people were skeptical about, the whole deregulation of the oil and gas sector, right? I mean, there's already been skepticism that what happens, the true test will come, okay, when oil prices go up, right? Whether they will be able to pass it on to the end consumer, or the oil marketing companies will have to bear that subsidy, or whatever, upstream companies and downstream companies. And we've seen that, right? Despite all the increase in the oil prices, I think everything has been passed out, and oil prices are now at petrol, diesel prices are at in whatever 3 digits. So I think the government, I don't think, will wave away from the path of reforms, what they have saying. There could be delays and there could be challenges which could be there. Like we see the privatization, few companies which were identified earlier, they are facing some challenges because of some of the global factors. Post-pandemic, there have been issues. But I don't think the government is going to change its path. Obviously, as you move towards elections, the government tends to be slightly more taking care of the population with election in mind. And the measures could, but that won't be the cost of reforms. Reforms will continue, but probably more focus will be in terms of how to take care of the larger population, right? Okay, the lower end of the masses, right? Because these are your vote banks, and what you do to address their concerns and over there. So, and that's a natural way for any government, okay, to play that. But I don't think that's going to alter the overall growth of the economy or the pace of the economic growth what we are looking at.
Next question to Bhavdeep. So once again, the question is asking on how do you see the trend on international funds, and ideally how much exposure by aggregate level, investor level, one should consider for this?
Yes, I think that's a good question. And I think many investors have this at the top of the mind, particularly last 2-3 years, international equity funds have become more popular in terms of investors' attention and need for portfolio diversification. We definitely believe that there is a scope for investors to kind of allocate some part of their portfolio. My sense is anywhere between depends on the size of the portfolio, etc. But I would say anywhere between 5 to 10% of the portfolio can definitely go into international equity. And there are so many businesses where business models are not available in the listed space in India, and we are the consumers of many such products and services, which are listed in global markets. So I think some part of exposure in international equity is very important. At the same time, so currently, for example, we are offering this NASDAQ fund of fund we have recently launched from 15th of this month to 29th of October. And then there are so many such fund solutions available. Our belief is that it's a good portfolio diversifier for investors. And essentially, all of us know that it's not about the different asset classes, but the correlation of asset classes, which is important for diversification. And from that standpoint, I think there definitely is a space for someone to invest there. Also, I want to highlight that in quite a few of our funds, we have been taking some part of exposure in international equity. whether it's our Digital India Fund, for example, or quite a few of our funds where we are actively looking at opportunities wherever we see a case for enriching or building up our portfolio from the diversification point of view. We do take exposures of 5 to 10% in international equity, whether it's, as I mentioned, Digital India or dividend yield fund. We could potentially do in many of our other funds, including ESG, for example, or some of the other sectoral offerings. So yeah, I mean, we believe that it is an important role to play. Mahesh, would like to add anything?
Yeah, I just to add over there, I think it's more about also from an investment side to build capabilities over there, because okay, that's a different domain altogether. We're trying to do that internally. And how do you look at this landscape? Because there's a huge number of companies, right? Where do you invest in, and how do you really evaluate what's the process of identifying these companies? So we're trying to build capabilities over there and do that. We made some progress over there, especially in the technology space and the consumption side. But increasingly, you will see us making more exposure as we build capabilities and the whole infrastructure to evaluate and monitor some of these investments.
Okay, thanks. Mahesh, quickly, next question from Mr. Nazamuddin. What's your view on the oil power utilities in PSUs? Any particular view?
I mean, PSU whole segment is now slowly starting to get some traction. They were always value plays, good dividend in stocks, good cash flow companies, but not much of a growth in these stocks. If you look at the power sector specifically, that's been the whole ESG theme, which has taken away investors from most of the PSUs were in the traditional, right, thermal production, and that led to the derating over there. So they were still growing, but I think the ESG concerns, many investors were shying away from that. I think some of these companies are now starting to also, like in the private sector, trying to move and having a plan, okay, for renewables, right, clean energy also plants. So that is leading to some potential re-rating over there. So the sector looks fairly, it's a good defensive sector with reasonable valuations, good yield, dividend yield, and especially at this point in time in a market where you are also concerned about downside, right? Looking at downside protection. At the same time, you want some incremental returns and what fixed income can offer. I think some of the PSU stocks still offer good value over here, and reasonable amount of growth, even if there is no re-rating of multiples. In the oil and gas sector, also, I think with oil prices going up and likely to remain higher. I mean, earlier we were thinking oil prices would go down because of move towards cleaner fuels, global economy kind of slowing down. But what's happening is that there's no investments happening in the oil sector, right? So probably oil prices remain elevated for some time, and the oil stream companies can continue to see good profitability. So I would say, I mean, yeah, not bad, reasonably good risk reward, and decent margin of safety in some of these stocks.
Okay, thanks, Mahesh. For the paucity of time, this is the last question to Bhavdeep.
Yeah, sure.
Yeah. Is it wise idea, to look out for the mutual fund schemes, okay, which offers insurance also? So, as an investor, is it a wise idea to invest in a mutual fund schemes, where insurance benefits are also attached to that? So, what's your view on that?
Yes. So we had offered Century SIP earlier. We have kind of because of the COVID situation, the offerings has to kind of undergo a little bit of change because of some reinsurance reasons and other reasons. But we are actively evaluating to kind of relaunch our CSIP, Century SIP, in some time. The benefits continue to kind of be available to customers who are currently running Century SIP or so. Those who have kind of enrolled into Century SIP before March 2021. And very soon we will be, I mean, hopefully next couple of quarters, we should be able to come back to you with some different version of Century SIP. But yes, it just makes a perfect sense. I think Century SIP it brings the best of both mutual fund industry and insurance. I think the best of mutual fund proposition is SIP as an approach, and insurance is term insurance. And I think combining both the ideas makes a perfect sense for retail investors or even the high net worth individuals.
Okay, sure. Thanks, Bhavdeep. And the last question to Mahesh, I mean, which is a very common question which I can see. Which are those common sectors you feel that can lead this cycle?
Yeah, so as we talked about in our earlier presentation, right? the themes, so I think it has to be led. I think up till now, it was the first leg of the cycle, right? The rally was led by global cyclicals. Right? We saw the IT sector do well, commodities did well, right? And stuff. I think at least going forward here, I think some of the domestic cyclicals will start to take the market higher from here as the growth, economic growth starts to recover. And if you take that, then the banking and financial services sector, okay, which has still been a laggard, right, in the last 1.5 years, has legs to lead that. Also, the industrials, though it's not a large weightage in the index, so it won't really matter much, but industrials and the whole cap goods sector is to be led by the investments-led growth, could be another sector which could lead that growth. And also other plays like the consumer. I think India is going to be a large consumption country. Discretionary consumption is going to increase, and as the per capita incomes go up, India is at an inflection point where the per capita income is now crossed around $3,000, and that's a point where we've seen a lot of demand for other discretionary consumer items starts to go up. What we saw in the other markets, so discretionary consumption again will continue to grow as penetration increases. So these are some of the sectors I think which will drive the market from going forward.
Thanks, Mahesh, and thanks, Bhavdeep, for all the insights. Thank you so much, to our all dear investors for joining us for, this first kind of initiative. And definitely, as Bhavdeep and Mahesh has also promised, as a MC, we will come out with this initiative once in a month, Niveshako se Samvaad, and definitely this Samvaad is going to help you, not only for your wealth creation, but of course, it's about your capital protection also. So going forward, definitely, I think, okay, one quick question, Pushpesh, this presentation, yes, definitely. I think within next 2 to 3 days, you will get all the crisp pointers of all this conversation. So thank you so much once again for joining this, and thank you so much for your time. Going forward, definitely, and just one quick summary, which I want to get that, all those 4 to 5 recommendations, those upcoming themes, that can be seen in those 4 or 5 our recommendation list where it's a combination of flexi cap, multi cap, frontline equity. To take care of your entry or exit, I think that's the best option to leave it to the fund manager. And I think business cycle fund, which is a very good opportunity where fund manager can take where buy and hold strategy. Let's fund manager demonstrates that. And thank you so much for all your time. And this Samvaad will go continue, and definitely it will help everyone.
Thank you, everyone, for joining us. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.